Thanks for coming. It's Forecast 2021. We're going to talk about the road to a new normal, and I think that's a pretty good summary of what we're expecting. What we're going to do is we're going to talk about where we've been, where we are now, and where we might be going. And some of the stuff you're going to have heard, maybe there's some flavor that we're going to be able to offer, but hopefully you'll see how this is going to translate into portfolios. All right, we're going to get into where we've been. So starting talking about the U.S. economy, the way I'd like to think about the U.S. economy today is that we're like a semi-truck. I don't know if any of you are going across, going through one of the toll booths across a bridge, and you have to stop behind a semi-truck. And if you get stuck behind a semi-truck, it takes forever to get through the toll. And if that toll happens to be before one of these bridges that's on a hill, then it takes forever to get going. But there's also momentum. Also takes forever to stop. And when we think about what happened in 2020, the COVID pandemic brought the market to a screeching halt very, very, very quickly. But the economy slowed down. It slowed down very quickly, ultimately. But then the fuel that came out of the CARES Act sped things up or started things going as they shifted down and started moving forward again. But again, it takes a long time to get that semi moving up that hill once it's slowed down. And you see this in the numbers that came out in the GDP. And we've talked about this a little bit, but you see a massive decline in GDP in the second quarter, right? And then in the third quarter, you see a massive increase. But it doesn't improve. It doesn't make up for what we lost. It doesn't bring us back to trend growth that was on pace before COVID. And the anticipation is, I think it's this Thursday, the first print on GDP comes out for the fourth quarter. And the anticipation is that'll be about 5% on the quarter. So maybe by that point, we will have recovered what we lost. We're still not going to be up to trend line growth, but we will have recovered what we had lost. And then shortly there towards the end of the year, we did get a new wave of the virus. And what we saw was a lot of those shorter term numbers were getting better and better and better. And then all of a sudden, those shorter term numbers started turning and getting worse again. And it was just announced that I think tomorrow, a lot of things are opening up and giving us some opportunities to go back and eat in restaurants again. And so we've gotten it under control. That's what the closure was for, was to protect the hospitals and the medical system. But this new wave of the virus towards the end of the year made people start talking about a double dip recession. We don't think we're going to see a double dip recession. We don't think that's going to happen. So it doesn't mean it couldn't happen if something goes wrong with the virus. And we'll talk about that as a risk thing coming up later. At the same time, and you see, and this always happens this way, economic problem, immediate employment collapse. And we had 20 million plus people lose their jobs in a matter of a month. And we've regained about half of those jobs, meaning there's 10, 12 million that are not back yet. And it was looking really, really, really good. And we thought there'd be more hiring for the holiday season, but it couldn't show up because things had to stay closed. And so pretty much everyone did their shopping on Amazon. So Amazon, to the extent that Amazon had warehouse workers and not robots, then there were people that had to man those or person those warehouses. To the extent they had deliveries, I don't know about you guys, but a lot of the stuff that I ordered came later than expected. There weren't enough trucks and enough drivers to make it happen. So the easy unemployment recovery is finished. The difficult slog ahead is the 10 million jobs, probably 8 million of which are small businesses that aren't around. So those coming back is going to take a lot more time. And it'll take, so at the same time, you've seen some of these small businesses go out, you've seen a lot of business starts, but those business starts are very, very small businesses, like one person businesses, sort of what are those called? Gig economy businesses. Someone is now selling their ability to edit documents on Upwork or something like that. Hopefully, we'll see a resurgence of smaller mom and pop retail restaurants once we have that opportunity, once we have vaccines. It's pretty much all reliant upon the vaccines. And this is kind of the current picture of unemployment. And what you see here is you see U3 and U6. U3 is the thing we look at as the unemployment rate. That's the dark blue line. U6 are the folks that are marginally attached, meaning they took a part-time job when they wanted a full-time job, or they're working, they don't have the job that they should be able to work. And so U6 is often quoted. U3 is the one that's actually recognized as the unemployment rate. And you can see that while it's moving lower, it is nowhere near the way it was in December of 2019 and January of 2020. So we still have a long ways to go to get back to what is probably going to be called normal or acceptable unemployment. However, that being said, talking to a bunch of people about this, there's an assumption that you'll see unemployment rates down around 5%-ish, which 10 years ago, that was considered good unemployment. 20 years ago, that was really, really good unemployment. And they're thinking maybe 5.2 by the end of 2021. And then we're down in the 4s again by the end of 2022. So there's a lot of thought that we will see a lot of businesses come up. We'll have to wait and see on that outcome. Even though those jobs are lost, and this is something that's really important when we get into some of the questions that people have been asking. Even though those jobs were lost, people kept spending, and people spent a lot. I mean, retail sales have more than recovered. They're above where they were before pandemic. So that's kind of amazing. And what those things are is durable goods. What we've seen a huge uptick in people remodeling their homes. And we've seen actually non-durable goods also go, they're up above where they were. And you can see that in the purple line and the green line. The things that are still suffering, personal consumption and services, like you can't get your haircut. So that's obviously down. And then things like restaurant services, those are down. So you see that that's still off, 8% from where it was before the pandemic. So this is two different looks at real GDP. Now the question is, when you look at this, is GDP up or is GDP down? And it all depends. You're going to hear lots of statistics, lots of reasons for different policies, and it all depends on which data set you're looking at. Now, if you're looking at quarter over quarter, that's the blue line, right? Quarter over quarter, it looks like we did really well. But if you're looking year over year, we have not yet recovered. It's just good to keep that bit of information about what are the numbers we're looking at. It's good to keep that in mind when you're thinking about these kinds of things or hearing about it from someone like me. So there's a lot of reality in the economy is recovering. It's in the process of recovering. And we always have to remember that in late 2020, November, there was an enormous level of anxiety. I think that this had probably more to do with the political environment than it did with finances. But when you ask people how they felt, this is survey data, 46% were worried about job security, 47%, probably the same set of people, were worried about paying their bills. There is an interesting conversation to be had around the volume of the economic stimulus or the economic support packages and the targeting of the economic support packages. So we have clients who called me the morning after the Fed put money in their bank accounts and asked me, what is this money for? Because they're fine. They're retired. They have plenty of money in assets, and they were like appalled that they received money from the federal government as part of the stimulus. But when you put money to work, when the federal government puts money to work to a lot of people as quickly as possible, some people are going to get it that don't need it. Some people are going to get more than they need. Some people are not going to get as much as they need. Some people aren't going to get it that need it. And that's the problem with targeting these kinds of things. And I think that one of the things you'll see out of this, one of the discussions going forward is you'll see things put in place that support better targeting. Things like better information gathering. Like for someone that's retired on Social Security, their income fit into a bracket that made them look like they needed money from this, but they didn't necessarily need money from this. So we'll gather data on new things, I think is what's going to happen. So a lot of stress. But just like the economy is like an 18-wheeler, the stock market is like a sports car. And the thing we saw in 2020 was the end of the longest bull market in history, followed very quickly by the shortest bear market in history. And by August of last year, markets were at new highs again. And this is kind of what you can see, that the black line is the S&P 500. The pink purplish line is volatility, which you can see is almost the inverse, not quite the inverse, but almost the inverse of the S&P 500. Something that's really interesting is, we broke through levels of, can you see my arrow? We broke through, this is like August right here. We broke through the levels that we had reached back here at the peak in February. We broke through those levels again in August, but then we dipped down below, right? And then we went up and then we dipped down below. So we're testing this place, this line, this what's it called in resistance. We're testing a resistance level. What do you think happens right here at this little dip here in November? What happens there? It's tough to tell. It's probably part election, but on November 9th was the announcement of vaccine. So it's a combination of those two items. It's vaccine and election. I tend to think it's probably more vaccine related than it is election, because again, we're talking about half of the country is not happy with the election and the other half is happy with the election. But everyone is ecstatic about the fact that we have vaccines, viable vaccines in production, vaccines that work. And so we're pretty excited about that. And we're going to talk more about that November 9th date. Remember that November 9th date, because we're going to talk a little bit more about that in a second. So the other thing to realize, you guys remember after 2017, we talked about how the year was just such a wonderful year because we all had such great returns and never had a down moment. And well, 2020 was more volatility than normal. We returned back to the volatility we experienced in the Great Recession. And the only other time in the last 30 years that we've experienced that kind of volatility before the Great Recession was the third year of the dot-com collapse, was 2002. So it was a volatile year, huge ups, huge downs, and you can definitely feel that throughout the year. But the end of the year was a spike upwards. And what we're looking at here, the black line is the S&P 500 PE ratio for last year. It's the PE for trailing earnings. The blue is the PE for future earnings. And so you see there's a big difference there. And it often expands and contracts and expands and contracts. The purple is the recession period. So one of the things this is important is when you're looking at a PE ratio, going back to that same chart we looked at with the GDP, people can quote lots of different things. And there are PE ratios when you measure them, when you measure the current price versus last year's earnings, the PE ratio looks completely out of control. Like it's really high, really, really high, higher than it was in 2000. But that's because right now we're looking at a quarter or half a year with very, very low earnings, whereas we're looking at prices that are looking forward. Does that make sense? So that leads us to this question. This is the question I think we've gotten more than any other question, is why did the stock market do so incredibly well? And is there a disconnect between the stock market and the economy? And definitely, we've answered this question live before, but there's definitely a disconnect between the stock market and the economy. There's always been a disconnect between the stock market and the economy. And that happens for a couple fundamental reasons. The first reason is that the economy, all the data we see about economics, the reported data is backward looking. So it looks at what happened last week, last month, last quarter, last year. That's what economic data, it's data that reflects what has already happened. And often it's twice removed. So it's data that they aggregated, brought together, they gathered, they aggregated it, and then they thought about it and measured it and thought about it, and then they reported it. So it's usually older data that you're looking at. What the stock market is it's a future return discounting mechanism. The stock market generally tries to figure out, okay, what this thing that's happening, how is it going to affect consumption? How is it going to affect earnings? How is it going to affect growth in the future for these companies? And so the virus happened and the stock market plummeted. And almost immediately, I mean, faster than I've ever seen it done, the government said, central bank came out immediately, like next day, and said, this is very bad. We're going to start doing things. We're going to buy bonds. We're going to implement QE. We're going to loan to anyone that wants it. We're going to buy government bonds. We're going to make sure there's enough liquidity. We're going to buy corporate bonds. We're going to make sure that companies have the ability to borrow and survive this thing. So the Fed stepped in huge. 2 weeks later, 3 weeks later, the government stimulus came out, and there's 2.2 trillion levered to about $4 trillion. We have to remember that I told you that was going to happen. Did you guys hear that? All right. So we have to remember that the second round of the Paycheck Protection Program that started early back in the day was undersubscribed. There was $190 billion that they had available that no one borrowed. And then they gave it back to the Fed. So they put so much money into the system, and that money went to support jobs, went to support people, went to support, and there's a whole argument about targeting. We're not going to probably get into that part of the argument, but there's a lot of money there, and that money goes through into the economy. And when that money goes through the economy, it goes to Amazon. If we can't go and shop, and Christmas happens or the holidays happen, we can't go and shop, we're going to have stuff shipped to us, and that was definitely Amazon. You can also buy through all kinds of other direct places, but Amazon is definitely the easiest. And then another thing that happened is there's 5 biggest tech companies in the United States were, I think, 90% of the return that occurred in that period. They're 25% of the market, but they're 90% of the return that occurred in a year. So if you were diversified at all, you didn't see that. Their average return is something like 60%, those 5, for the year of 2020, because everyone else shut down. But Microsoft became a required tool, right? It was a needed thing. Amazon became a required tool. It was very important for these people to have, for these companies to be in existence, because that's what enabled everything else. So we talked about the stock market looking ahead, and the last thing is the low interest rate environment. And it got lower and lower and lower throughout the year. By the way, so it's not closed yet, but I'm just quick reporting. I've been trying to close a refinance on my house at 2%, not because it was already a pretty low rate, but just because I want bragging rights for the lowest possible mortgage rate. So here, Scott's shaking his head like, why are you saying that? So this is the low interest rate environment. So back in December of 2019, the 10-year Treasury was like 1.8, 1.7 to 1.8. In July, August, September, it got to 0.5, 0.6, 0.63%. So that is let's put that in context. What does that mean, a 10-year Treasury rate? That means you're going to buy a Treasury bond from the US government, and the US government is going to give you this rate of return and give you your principal back in 10 years. What that is the risk-free rate of return. So a 10-year bond at 0.6% is what qualified as risk-free. So what that means when you think about an equity risk premium is the additional return you expect from equities over and above the risk-free rate of return. And if you think about that as like a 6%, then a good year last year with the 10-year Treasury paying 0.6 would have been 6.6, right? We had 18. So last year was an incredible year. It was a much better year than we could have anticipated or expected, especially given what was happening. And because of that, because rates got down so low and they've already begun climbing back, and I realized that I have got to sound like a broken record with this by now. I think every time I stand up in front of people and present this chart, I say it can't go any lower. But this time, this time, I don't think it can go much lower. Even if it did go lower, I mean, we've seen kind of the lower bound in the German bonds and in some of the in the Japanese bonds, and that lower bound is a negative 0.3, 0.4. It's not much further below where it is today. So why is this important? We have, as of January, I think 12th, we have changed our fixed income exposure because of this issue. Couple things. If the long-term diversified portfolio produces a 6 or 7 or 8% return, depending on your weightings, but the expectation is that your bonds are going to produce an average of 5 or 6, which has been the expectation for many, many years. And interest rates are at less than 1% and going up, your bonds will provide no returns. In fact, it's likely that bonds will give you a slightly low negative return. So what does that mean? Does that mean you get rid of bonds? No. Because bonds are also, they're the only thing we know of that's a very good quality counter ballast to equities. So we still have bonds, but our bonds are very short in duration and they're very high quality. We're not taking market risk in bonds. We're taking some duration risk, some interest rate risk, but we're not taking market risk in bonds the way we once did. And so that change is one of the big changes in portfolios coming into 2021. And I would guess that change is going to exist for many years into the future. And this is probably the second question I get, so we spent $3 trillion more than we brought in 2020. The expectation is we're going to spend $3.5 trillion more than we bring in 2021. What does that mean for inflation? Couple things. The first thing, and I don't want to get too deep into this, but I think it's important to cover. It's not just the amount of money we spend in excess of what we bring in that matters. It's where we get that money from. So this year, 2020, 3/4 of the money was government printed money, and government purchased their own bonds. And so there's a big argument that's being hashed out in the economic circles about whether or not that works long term. And we're not going to weigh in on that argument. The question is next year, and the challenge we're going to have next year is the way it's written. The Fed has not agreed to buy that level of bonds again. So what that means is if we assume $3.5 trillion in additional spending more than we take in, that has to come from investors. So I don't know about you, but I know that if I'm lending money to somebody that has that much debt, I'm going to demand a higher interest rate. There's no way that you're going to get that kind of lending from individuals unless A, they're very, very levered, and they need the security, but they're levered for that security for a return, or B, it's the federal government. Like there's no way to entice me to invest in something where I'm guaranteed a 0.6 or lower return for 10 years. So that's interesting. So that means the Fed is going to have to probably allow rates to creep up to entice people to buy bonds, or the Treasury is going to have to change what they've stated, and they're going to have to agree to buy more bonds. This conversation is going to get into MMT huge next year. That's modern monetary theory. There's a lot of economists, some here in Berkeley, that say that we should be able to borrow and spend all we want, and maybe not. That's something we may want to be careful on how we test. So some of today's inflationistas predict a possibly high but transitory spike as consumer spending bounces back from the pandemic. So there is sort of a statistical spike that's going to happen in inflation. So inflation looks back 12 months. And again, this is how it's measured. So we will probably see in 2021 an inflation jump to about 2.5, maybe a little bit more than 2.5%, but then it should settle back down. And the reason is that's going to be a comparison with 2020's mid-year data where inflation was negative. We didn't have inflation for a quarter. So then the big jump that occurs isn't actually a big jump. It's an interesting comparison. So we're going to get into where we are. We're all figuring this out, working and learning from home. And I got to say this, the biggest struggles that I have heard are from parents. There's two sets of struggles that I'm hearing that are awful, and my heart goes out. People that are alone, single, whose kids have left, who are older and just don't have a lot of interaction with other humans. Zoom doesn't cut it. So those folks I really worry about. I worry about depression. I worry about, just them sort of throwing caution to the wind so they can be with other people. And the second group of people, and we have a lot of clients like this, that have little kids at home and they're trying to work from home and their kids are learning from home and they're on Zoom and can you imagine a second grader, taking class through Zoom? I'm glad I don't have second graders or third graders. I'm glad I have a 7th grader and a 10th grader. It's just easier, I think, for me, but we're coping, we're coping. So this is Liz Ann Saunders. I think she's one of the smartest people in the room. If vaccines represent the light at the end of the tunnel, the virus means we're still in a fairly dark part of the tunnel. And I think that it got a little bit better with announcements that are coming out, but I still think we have a ways to go. I know that the rollout of vaccines has been less than stellar. And that's actually one of the big risks we face, is it continues to be less than stellar. But there has been this rotation that it had to come, but the rotation has been, and you've heard me talk about these in the past, and we're going to look at some numbers here, but growth to value, large to small, defensive to cyclical, stay at home to out and about, leaders to laggards. So the companies that had a growth bent to them sort of gave way to companies that have value bent. Big companies gave way to small companies, and defensive companies gave way to cyclical companies. And this is what that looks like. So remember I mentioned that November 9th date? So for years now, and by the way, it hasn't hurt us that much on a long-term basis, but there have been many periods in the last 7 years where we've had to say, small and value works long-term. It doesn't work every time. And we've had to be very clear that we have a philosophy, we have a process, we know it works long-term. It doesn't work every time. For the last 7 years, value has underperformed growth. And almost always, and I think I said this in July, almost always when there's a big, growthy peak, you see these growth companies start shooting the lights out and they're just doing incredibly well, and everyone just starts floating to them and putting more money in them. And then something happens. This time, the something that happened was a virus. And that something, you can kind of see this in these numbers. For 7 years, this chart would be completely reversed. And what I mean by that is the big numbers would be here and the little numbers would be here. And you can kind of see in this chart that when you go from big companies to little companies, you see outperformance between November 9th and the end of the year, which has continued so far this year. And you see outperformance in the value relative to the growth. So what you see in this chart is what happens over long periods of time. That differential occurs over long periods of time. 7 years leading up to November 9th, you saw better numbers up here. Now, this isn't me saying, hey, I think it's, clear sailing ahead. But there's a lot of reasons to think that small in value begins to come back into favor and begins to close that gap a little bit here. However, and this is another, is it finally time, though, to buy back into these shares of these unloved and cheap companies? So on Monday, November 9th, Value stocks beat growth stocks by the widest margin in any day since the 1930s. The question investors face is whether that's some extraordinary move or whether that's a sort of, it's going to end that grim 7-year period, 8-year period, or is it just a false start, right? And we don't know the answer to that question today. But the reality is, when we invest, we don't choose between one or the other. We are broadly diversified. We own the Apples and the Amazons. We own them in a smaller percentage than they exist in the S&P 500. This is the problem with diversification. It always works. It never feels like it's working. So on the very right-hand side, you see these faces. You see what it feels like. So in 2000, 2002, I lost money. I was diversified. I lost money. But in 2003 to 2007, I didn't make as much as the S&P. And then in 2008, I lost money. Then 2009 to the last 10 years, I didn't make as much as the S&P. Then in 2020, I lost money. You see this, right? But the reality is, over time, right, the total return of the I lost less money, I made less money, that total return, it does lots of things. It provides a similar long-term return. It provides a more predictable access to capital in the interim. It provides an easier, more tax efficient. So the reality is, this return has been taxed away a lot. This return has not been taxed away as much. So there's a reason to have a diversified portfolio and to always have a diversified portfolio. That's why we use this as one of the anchors of how we invest money. Still, there is a rough road before we get to this, to a brighter future, right? There's a lot of issues with vaccine delivery. There's lots of challenges with that. We're seeing that every day. We still have long-term unemployment challenges. And when we talk about long-term unemployment, I'm talking about people that have been unemployed for 6-8 months. There's a probability that someone that's been unemployed for that length of time doesn't re-enter the job market. If that person doesn't re-enter the job market, that's just expertise and productivity that we'll never see again. So that's a risk long-term to our economy. Small business destruction we've talked about. I don't know. I think it was an article on Yelp. I think Yelp said 50% of the businesses that used to be on Yelp are going to not exist. That's enormous. That's a lot. There's also, going into the end of the year, we had questions about whether or not we were going to get economic relief package or what those are going to look like. I think looking forward, I think we can expect another package. I think we can actually expect, and I hope we can expect, an infrastructure package of some kind. And then I think we'll have a review of the economic safety nets. I think we'll have a review of our unemployment system in the next few years as well, so that this isn't a big question. Another thing that happened this year, 2020, was we gave a lot. It was a challenge. A lot of things happened in 2020. There's social justice issues. There was small businesses that were going under. There was just basic needs. People needed food, but we rose to the challenge. So in 2020 compared to 2019, giving went up about 7.5%. In the first year, total charitable giving went up 7.5%. But small folks, people that have donor advised funds, not foundations and endowments, but people that have donor advised funds, $50,000 in a donor advised fund, their giving went up 46%. And I say this because you guys might remember this. A couple of years ago, donor advised funds were pretty well maligned. People were saying that they sit on too much capital, they don't give enough away. It's a giveaway to the rich or whatever. I think it was the fact that we sat on this capital and we had it available to us when we needed it that enabled that huge jump in giving from donor advised funds. So let's talk a little bit about where we may be going. Some of the trends that started in 2020, work from home, housing market boom. It meant spending more time at home, and people found that they needed more space. So you saw people upsize their homes. People found that it didn't have to live in proximity to their work, so they moved to other places. Kate and I pretty consistently consider a house in the mountains somewhere, and so we were looking, and this wasn't for us to move to because of the pandemic, but just because we ski and we like the mountains. But we were looking in Tahoe, and every single home that went up for sale in Tahoe was gone, like snapped up immediately, because people discovered that they could move someplace else. Um, Americans' savings skyrocketed. I'm not saying that that's going to continue, but a lot of that has to do with people that got money that didn't need it, people that got bailout money that didn't need the money, or a lot of folks, since we're staying at home and not traveling, we didn't have anything to spend money on. We couldn't go out to dinner. I think a lot of folks had more wine and more bourbon, but we didn't go out as much. Sustained innovation and technology adoption. A lot of the things that enabled us to work from home brought the future forward. So there's some things that won't change. Some people won't go back to the office. We talk about internally, I think we'll always have an office and we'll always have people in the office. The question is, are we all going to always be in the office, or can we work from home some? Does that make sense? Are our clients, are you going to want to, save the time and not drive down and see us? Are you going to want to have more meetings on Zoom than we had before? That's possible. I think that the demand for electric cars is going to shoot through the roof, which means more cleaner energy in cars. And we did see a little bit of a relaxing of the pursuit of social justice, but I do think that that's something that's a long-term thing that's ahead. We have to figure some of that out. This is something that doesn't happen very often. So the 2021 economic GDP growth outlook is synchronous. What this means is the expectation is almost every country on the planet is going to see pretty big economic growth this year. What that means is, lots of goods and services. They don't think it's going to start probably till the second quarter, but we're going to see this come together as vaccines become more widely available. And as the newer vaccines that aren't yet completely through the process are approved, and they already have billions of applications of these vaccines available. So when they're approved, they will be immediately available much more broadly. But this broad GDP is a big deal. So this is a huge tailwind. Remember the semi? This is the global semi. And the global semi's momentum is picking up, and it's going to be big in 2021. We may not have heard much about this because these are two things that we're actually not part of. These are two massive trade deals. One that's the largest trade deal ever, that is China and all of the surrounding communities. And it's massive, and we're not part of it because of our leadership in the last go round. So we will probably be working to try to become part of this. But one of the reasons that we are very committed to international investments is because trade has just improved in a huge way internationally without us. So that should have an effect, and most, like Goldman and JP Morgan and most of the analysts we talk to, suggest to us that the strength of the dollar, which has been really, really strong and has waned in strength since the pandemic began, will continue its longer term trend down relative to a basket of global currencies, which means our international investments will be far more valuable in the future than they are today, assuming that trajectory. The nice part about that international bit, though, is we're actually paying a lot less per unit of earnings internationally than we do domestically already. So we are and have been accumulating those for a number of years, not in anticipation of this, but in expectation that the market would someday recognize that, yes, really what we want is earnings, and earnings are cheaper elsewhere. So we see 5 risks, and I think these make perfect sense or easy sense. Vaccine effectiveness. There's new strains. Does the vaccine work across all the new strains? The pace of the recovery. A lot of that's going to have to do with, do we have what's our spending bill look like? Do we have additional support? Are we going to do an infrastructure program? To the extent that we have additional supports and an infrastructure program, you're going to see so much investment in the U.S. and globally. I think it will be a surprise to most of us how positive it'll be on GDP and on employment, frankly. This, for me, if we weren't in the middle of a pandemic, economic recession, this would be number one. So when we're out of this, that's why this is here. U.S. and China tensions. We tried to just fight with China on our own by ourselves, and hopefully, what Biden will do is coordinate the globe to rein in China's bad actions. And they are not good competitors. They're not behaving, and they haven't ever. And so I think it's time for that to be slowed, but we can't do it on our own. We're no longer that size. So this is consumer habits. I think there's a lot of questions on what changes are permanent and what changes are gonna change back. What things are we doing that are gonna stay different? And I don't know the answer to that question, but those habits, companies are gonna have to figure those things out. This last one's really interesting, investor behavior. One of the things that you can see in the data is when the money hit individual accounts, like when the first round of Fed checks came out, the next week you saw an uptick in call buying. So what is a call? A call is a cheap way that you can profit on the increase of a stock and limit your risk to the price of the investment. So I can, for $1,000 or for $600, I can buy 4 or 5 calls on Amazon. If Amazon goes up, I get to profit on that. If Amazon goes down, I lose the $600. So there's a lot of additional trading that occurs when these checks hit. And so we're going to see another check come in. We're probably going to see a lot more volatility and a lot more very quick trading oriented things happen. A lot of that's driven by individual small investors. So that behavior is interesting because there's been a bunch of research. I actually think some of it was done at Cal by one of David Glotzer's friends at Cal, who did a research on what is the name of the app? Scott, what's the name of the app that everyone's on?
TikTok.
Say again?
TikTok.
No, not that one. The trading app.
Robinhood.
Robinhood, thank you. So there's been a lot of research on Robinhood and how the vast majority of players on Robinhood they're just trading the thing that gets quoted the most on TikTok or on finance TikTok or on Twitter or on the top screen on Robinhood. And all of those things are things like Tesla that has, I don't even know what the PE ratio is, but a ridiculously high PE ratio, which means those people eventually don't have the money to trade anymore, and that slows down. But that investor behavior is interesting. So the checks have an effect on that. The fact that last year we went to no transaction costs on ETFs and stocks, most custodians have an effect on that. So there's no friction. There's no reason to not trade. And so that actually hurts people's trading. Doesn't work. All the research says that, but there's still a juice to it and people get attracted to it. And so you see a lot of it. And then this question is the one that will probably make me the most nervous over the next 5 to 10 years, is what do we do about this? And I think the first thing we see that's done about this is we're going to see higher tax rates. There's no other way about it. And some of that will be the corporate tax will probably be split the difference. Corporate tax will probably go for 28 from 20. If you make more than $400,000 a year, your taxes are going up. You're probably going to see a couple levels of that. I think it may be time for another level, like not just the 37 going to 39.6, but we may see another one at $750,000 of income. You may see a 42% tax bracket. Something like that's probably on the table. There's also on the table is capital gains being at certain income levels. Capital gains could go to levels of income taxation. You're going to see a change in the estate tax. We're going to have a smaller exclusion, or the tax is going to be higher. There's going to be lots of changes in that regard. So the reason this chart is important, though, is there's a lot of research that says that once this blue bubble gets over the 90% level, it starts to affect GDP long term. So we're up at 130% of GDP. So you're going to see a definite effort to rein this in. And that will be, you'll see from one side, and we've seen this before, cut spending, cut spending, cut spending. You'll see from the other side, raise taxes, raise taxes, raise taxes, raise taxes. It is probably going to be a combination, just because that's, we have a couple of years for sure where we'll be able to raise taxes, and that will happen. But then after that, this is a long-term issue. Now, the research that's been done on this can't, we've never had this experience. It doesn't include a country that has the default currency. So we have an advantage that doesn't exist in most other places that see problems from high debt levels. Do we keep that advantage? It's a question we can't answer right now. So a year ago at this time, America was the largest debtor nation in the history of the world. That debt is now up by trillions of dollars. That's trillions with a T. Someday we're going to look back at this 3 years from now, 8 years from now, and ask, wait a minute, what about all this debt? What are we going to do now? And that will be the burning question for the next, I think, many years. So lots of changes happen in planning as well. The Secure Act, gave us some planning opportunities with Roth conversions, made some limitations on stretch IRAs, did some other things. We just talked about changing tax policies. We're still in the middle of COVID-19, where we think we'll be coming out of that, second, third quarter of this year. But there's a lot of long-term planning opportunities, and we've projected them out in our weekly commentary. We've talked about them in our Q&As, and when we sit down with our clients face to face, we're going through them, the ones we think are going to be the most important to them. Two final thoughts. We've kind of touched on them, but COVID-19 has brought with it economic damage on a vast scale. Yet the rapid changes that have been forced on many industries are leading to innovation as well as that damage that's going to outlive the pandemic. So there are good things that are happening, and those good things will outlive the pandemic. And in some cases, it's leaving some of the really strong and mighty less mighty than before. So there's going to be some market rotation. We've seen things like Salesforce buying what did they buy? Scott, you said this earlier today.
Slack.
Yeah, that's right. So there's efficiencies that are being combined in other silos, not just Microsoft, not just Google. And how we work is changing. That could have a long-term disruptive effect on air travel, commercial real estate, restaurants in the downtown areas and such. We also know that we're going to lose potentially half of small businesses. Now, this is going to have a massive impact, and I'd say especially on a community like Berkeley, who has, except for CVS's and Walgreens, has basically kept out most chains. So a lot of the businesses, small restaurants in Berkeley aren't going to survive. So we should try to do what we can to support them and help them survive. And with that, I just want to say thank you, everyone that came. I'm here for questions. I want to see if Scott has anything you'd like to add. I didn't notice any mics go off except for the questions I had asked, but if you had anything you wanted to add that I missed.
Yeah, and the only thing I would say was, I think if this event was happening in March, April, or May, I think we would have triple the people on here. We had this conversation this morning because, although we had a hunch it wouldn't, a lot of people thought the world was coming to an end. And so I think it's nice to see a good turnout, because even when things are good, it's always good to plug in and hear what's happening out there. And it's always an evolving, fluid situation, to say the least.
Oh, thanks for the question.
Came in about donor advised funds. Jonathan.
Yeah, so a donor. So there's the old method of managing family finances around giving was the foundation. And the foundation is really, really, really expensive. And so I don't know how long ago it was, but a donor advised fund is basically an account you set up that you can contribute a lump sum of stock, equity, whatever, and you get a tax deduction, an income tax deduction, just like you would giving it to another charity. And it stays in that account, and you can invest it in that account, and you can give it away later. So the way donor advised funds often work is if you have somebody whose income is kind of zigs and zags. It's, some years it's big, some years it's little. Years it's big, you want to actually put more of your expenses into that year to reduce your income tax liability. So that might be the year you give a large amount to a donor advised fund. And then over the next 4 or 5 years, you give from the donor advised fund to the charity you want to donate to. So it's a way to concentrate in a single year the tax benefits from philanthropic giving. And at the same time, it's a way to, we use it often with a way to teach kids about money. So teach kids about the importance of giving and teach kids about how money is managed inside a donor advised fund. Because generally those are a way to show a child a portfolio without showing the child the entire family's fortune. And that's kind of a good idea, especially with, young teens, early teen, mid teens. Paul said, how did I get a 2% interest rate? Well, A, it's a 15-year, right? So it starts at a lower level. That's actually the biggest trick. B, I did pay, I think, a quarter of a point to get it down from 2.125 to 2. C, I trusted my mortgage broker. I just said, you know what? I want 2%. I want you to lock it when you think we can lock it. And so she did. And it took her 2 months to get for that moment to arrive. The moment arrived and she locked it. So we're not, but it's, this mortgage has been in process for about 3 months now and it's still not closed. So maybe it's 2.5 months. I'll believe it for sure when it's done, but I've signed papers. It says 2%, so I'm hopeful. Favorite ways to stay ahead of inflation. So it's a great question. So there isn't really a way to, where are you going to put your money? The question is, where do you put your money, right? And there's a couple places you can put your money that works with inflation. I actually think one of the best, and it will struggle, but one of the best places to put money in an environment that's where prices are going up is in a place that benefits from prices going up. And that place would be companies who can manage productivity and can innovate to, bridge the gap, to make a difference, to reduce costs in other places. So one of the best ways I believe that exists is to invest in the great companies of the United States and the world. There aren't really good, I know people talk about gold as an inflation hedge, and there is some reasoning that real estate is a good inflation hedge. But I think even that isn't as good as equities are, or as a business is as an inflation hedge. Because of productivity and innovation, you can stay ahead of the rising costs. That being said, you have to invest in businesses that do stay ahead of rising costs, and that's another issue altogether. So profitability, you have to buy things with the right kind of value, right kind of price points, and if you have someone that's smaller that isn't entered every market, they can actually increase their value by entering other markets. So that's one of the things that we talk about. Our baseline philosophy of investing in value over growth, small over large, and in higher profitability over lower profitability companies, that feeds into the reasons why that inflation thing. I do want to touch on, and I don't want to go down a rabbit hole here, but a lot of people, when they bring up inflation, think about gold, and a lot of people, more modern, younger folks, are thinking about things like Bitcoin. I just want to reflect back on 1980. I think it was 1982. And I had this conversation with my 16-year-old. I should have verified this, but I think in 1982, the S&P 500 was at $800, and an ounce of gold was at $800. And today, the S&P 500 is what? 4,000, 3,800?
It's the Dow.
No. Oh, sorry. The S&P 500. The S&P 500 is 3,200, right? I don't know what it is right now.
The Dow was 800 in 1980-ish, and an ounce of gold was about 800.
40,000. Yeah. Okay. So it's the difference is yeah, S&P or the Dow, the stocks have done really, really, really well, and gold has done well and then done poorly and then half as well again. And I've heard a lot of conversations about Bitcoin. I just would say we don't have enough time on that one yet. We don't have a way to analyze the value of Bitcoin, and that's something to be very aware of. It's being discussed as an inflation hedge. I don't think there's a reason to think it's I mean, I love the concept. I love the math behind it. I think blockchain's amazing. I think the security values are amazing. I just would be very careful in committing too much to something that's that volatile and trying to call it a store of value. It's hard for me to call that a store of value or an inflation hedge at this point. 50 years from now, we may look back and go, oh, yeah, it's a pretty good store of value. Right now, I don't think we can say that, and I think it's a speculation either way. You'll probably hear more from us on that one. I have a sense over time. Question coming in: do you think India and European stocks or international funds in general are likely to do better in the next year compared to American equities, or are there other sectors of the equity spectrum you're watching closely? So it's a great question. I would like to think that that equities and the international equities and European and Indian equities will do better next year than they have in the past. We have to remember that for the last, I just looked at these charts, I think it's for the last 10 years, Europe has basically not broken out of where it was before the Great Recession. And it literally just broke out. So the idea that markets are overvalued, I think that's probably true, but I think it's probably more true in the United States, way more true in the United States than is in Europe. Now, the reason this is important in my book is that just because the stock prices haven't gone up doesn't mean that the companies aren't more profitable. So the reality is the businesses that we invest in are producing more in a similar way to the companies that we invest in the United States. The businesses that we invest in the emerging world are doing more, producing more, selling more, having better cash positions, having better return on capital, return on equity. They're doing more in the same way that companies in the US are doing. The market, the people who are committing capital aren't committing it to those places. So the longer we sit and the longer that difference exists, company A in the United States has a 10% growth rate, company B in Europe has a 10% growth rate, but only company A in the United States goes up in value, up in price. The longer that exists, the more and more valuable this company B gets. Because really all we're investing in, the only thing we really want is we want the upside, we want the earnings, and we want to pay as little price we can for the earnings as possible. That makes us both subject to smaller, massive drawdowns, because we're not falling out of the fifth story window, we're falling out of a first story window. It also makes it gives us more upside when things like currency regimes change. So one of the advantages the U.S. has enjoyed since the Great Recession, last 10 years, has been a very strong U.S. currency, relative and a currency that is increasing in strength relative to a basket of global currencies. That can't continue forever. We're not the fastest grower. We're not the most fiscally responsible. We happen to have the global reserve currency. That's a nice place to be, but we can't rely on that forever. And the long-term trajectory, we've had a short-term boost in US currency, in the dollar, but that's not a long-term thing. That's something that happened in the last 10 years. Now we have just seen a massive transition, from large to small, from growth to value. And there may be a similar value transition that occurs, if only because the makeup of European and emerging markets is more, it's not as growthy, right? It's more cyclical. And if we're entering a trend of rising rates and entering a trend of declining dollar, Europe and emerging markets will actually do better in that environment. Difficult to say if that's today or if that's a year from now. So what I'd say is, we are 50% in the US and 50% elsewhere. And we have that because that's pretty much what the globe says. 50% of market capitalizations in the US, 37% in market capitalization is in developed outside the US, and 13% is in emerging markets. That's where we start. That's kind of where we invest. And the US keeps going. The last 10 years has done really, really well. So when we've trimmed the US and we've reinvested those funds in Europe.
There was like a part two to the question though about other sectors of the equity spectrum that you might be watching closely.
Well, I sort of took that to mean other countries. So sectors. If the question is really about sectors, we don't really do sector rotation. Again, we focus on things that go across sectors. So meaning value over growth, high profitability over low profitability, and small cap over large cap. What that means is we invest in all the companies in all the sectors, and we overweight those things that have value, profitability, and smaller capitalization. And the reason for that is no one knows what happens in the next 2 to 3 years, but the long-term data about what happens over the long term is very consistent. And so we invest with those three tilts because that works over long periods of time. And we don't think that concept changes, because those three things make a lot of sense. If you think about those three things, they make sense. I want to thank everyone for being here. Thank everyone for asking really good questions. And again, as always, thank you for being clients. And if you have questions after this, don't hesitate to give us a call. We are all here. We're all here to help.